All right. Thanks for tuning in. Pretty excited about today. Fantastic guest. Not every day we get the people of his caliber on here managing the kind of money we do. I'm Rob Tatro from robtatro.com, portfolio manager at Canaccord Genuity Wealth Management and the Tatro Wealth Advisory Group. Take a sec to subscribe to our YouTube channel. We put out some fantastic content. Give us a like, give us a follow on Facebook or wherever you're watching. Really, really appreciate that. We got to get to 10,000 followers. Guys, the guest on my show today, I'm really thrilled because we're talking about an asset class that nobody's talking about, all right? Not only is it private real estate, but it's private student housing real estate, all right? It's something that no one's talking about. Huge opportunity in this space over the next 5 years. He's going to tell us all about it. What we believe is there's going to be an appreciation of the value of the real estate in addition to an extremely tax-efficient cash flow. Probably more importantly for a lot of you guys, no volatility on the assets. So the assets are extremely stable. And as well, he's targeting a 15% return on equity, shareholder return. All that adds up to an asset class that you probably don't have in your portfolio. And if you're like one of those guys or gals who's got a traditional 60-40 portfolio at one of the large financial institutions, you are not getting this kind of stuff. Go to www.speaktorob.com if you'd like to book a no obligation consultation to chat about that. Enough about that. Let's bring him in, the managing partner at Alignvest Capital today, talking to us about student housing, Sanjil Shah. Sanjil Shah, thanks so much for joining us today. You are the managing partner at Alignvest Student Housing. Thanks for coming in today.
Thanks, Rob. It's a pleasure to be on.
Hey, if you're not sure who I am, I'm Rob Tatro from robtatro.com, portfolio manager, Canaccord Genuity Wealth Management, and the Tatro Wealth Advisory Group. Thanks for tuning in. Today, it's an asset class many people haven't heard of, student housing or student residences. I want to start with you personally, Sanjil. I want to start with your story. So what's the story? Where did you start in the finance world? Did you always know you wanted to be kind of a portfolio manager? Did you always know you wanted to run money and manage assets?
No, not at all. I started in a different career path. I spent 8 years at KPMG, grew up in the audit world as a chartered accountant. Then in about 2004, I was at a crossroads in my career. I had to decide what I want to do. Do I want to be a partner at an accounting firm or go be an entrepreneur and try something else? And, look, for me, I'd never done anything else since graduating university. I'd been an accountant my entire career at that point. And I thought, okay, it's now or never. So I came across an opportunity to get into another niche real estate class doing self-storage. So it was an interesting opportunity for me.
What year would that have been in?
2004. This was
so this is kind of before it went mainstream, right?
Absolutely. We were the pioneers in this space. And the parallels to what I'm doing in student housing today are striking. I jokingly like to say to people that when I was doing self-storage, I was storing people's stuff. And when I'm doing student housing, I'm storing people's kids. So, it's kind of, but what was really striking to us back then, Canada was kind of white space. There were kind of the orange garage doors on the side of the highway, very low penetration in the marketplace. But the US had kind of gone through this next stage in its evolution. And there were a bunch of public REITs that had emerged. Extra Space, U-Store, a whole bunch were emerging on the scene. And the idea was, let's just copy what's being done south of the border. We had 1 square foot per capita of self-storage space in Canada at the time. The US market had between 5 to 7 square feet at the time. So we're like, okay, even if we double the supply, we're still, a fraction of the supply that's in the US. And so that was the opportunity to get into real estate. I had a ton of fun. We built that up over 3 years. We grew to 11 facilities in Ontario, Alberta, and Saskatchewan, and then kind of sold in mid-2007, just before the economic downturn. We were very fortunate or lucky in our timing. And I was bitten by the real estate bug. I loved real estate. I loved being an entrepreneur. Specifically, I liked niche real estate where there's an operating angle because I felt like that's where I can differentiate myself. I'm not competing against the large established asset classes like retail, industrial, commercial. There are large players established there. And I wanted to be kind of below the radar, find something that's different. So when the opportunity came to do student housing, many years later, I jumped in. I was like, wow, this is amazing. At the time, there were REITs in the US, the UK, Belgium, nothing in Canada. And there was no professional management, no institutional capital being invested in Canada. So that's the opportunity. It's just copying what I've done and finding something that's been done around the world and bringing it to Canada.
Hey, where do you think we're at now with respect to storage space per square footage?
I think there's still a huge opportunity. So there are a lot of players, but if you read any of the current players' pitch decks, it's the same story. We have less than half the supply of storage on a per square foot basis relative to what's happening in the US. And there's still lots of space, lots of opportunity to grow in that asset class. I've been very tempted numerous times to get back into it. But, once you've done something, you want to move on and try your next challenge.
And you've kind of figured out what you're doing now, and you're doing a pretty darn good job. So I'd say maybe focus on what you're doing now. It's going pretty good. I feel like, last comment about the storage thing, I feel like I'm a Canadian, and I've always thought I lived rurally for most of my life, and we don't storage. That was such a foreign concept, because just build a bigger shed or a bigger shop or a bigger, if you're on the farm, if you're in the country, and we do have a bit of a higher ratio than that of the US, and we do have a lot more space, and we do have a lot less density in our population. Doesn't less density automatically lead to less need for storage? Is there a correlation there?
Yeah, so that's a great question. So, one of our assumptions was we'll never catch up to the United States in terms of our supply. There are a whole bunch of differences, in addition to the density. You think about Canadian mobility, it's not common for Canadians to grow up, move across the country 3 or 4 times, go to school in a different city, take a job in a different city, where we really have a handful of large urban cities where people, grow up, they go to school, they establish their careers and the families, and they don't really have that same mobility. When you look down south, it's common to go from New York to LA to Chicago and all parts in between 3 to 4 times while growing up, and go to college in an entirely different city. The other differences, of course, is Canadian cities, for the most part, have basements. So you've got that built-in storage capacity, right? When you go to the southern US, they don't have the basement, so they need that extra space, external space, to keep their stuff. So there are a lot of differences. You have to be the successful players in the self-storage space, really spend their time, do their homework, understand what the differences are between Canada and the United States.
And the thing with storage, and I know this from firsthand experiences, the renewal rate must be like 100%, because once you go to the storage unit, you can't go back. You can't fit that junk back in your house. It's kind of a permanent situation, right? Or you stop paying it, and then they get your stuff, and your stuff ends up on Junk Wars or whatever it's called.
Absolutely. I have a quick funny story around that. When we first started, the common approach was you give people a discount if they pay you cash. Any business, you pay by cash, you get a discount because you don't want to pay the credit card processing fees. I very quickly realized that that's a fallacy in how you should run your business. So I actually implemented a policy where we're going to give people a discount by putting credit cards on file, because what happens is out of sight, out of mind. And the next thing you know, that you've renewed the credit card billing 7-8 months in a row, and the person comes in and they're like, man, I was only planning to be here for 2 months. I totally forgot my stuff was here. And so, the churn rate, the renewal, is what you want to really optimize. So if you can optimize your turnover, your leasing cycle, that's really where you can make your money.
I bought this nice house in St. B with a lot of storage, and had a shed in the back in St. Boniface, Manitoba. And I was like, what are we going to do with all this storage? There's so much storage space here. Well, 6 years later, I now have 4 kids. I recently took a storage closet for the first time, or storage unit for the first time in my life. And I'm kind of embarrassed to say it, but just like the bikes, what do you do with them? We have like 10 bikes in winter. What do you, put them in the storage unit. And then the winter stuff goes to this. Anyways, it's good for you for seeing that trend before it actually happens. So I'm part of it a little bit. Okay. So now you decide, you see the future could potentially be student housing, or is there another step in between there?
Yeah, no. So in between, I was doing self-storage was my first entrepreneurial opportunity. Had an exit event, first time in my life I've had a liquidity event. So I wanted to try a few different things. I got involved in a few private investment opportunities. I was dabbling in hedge fund investments, private equity investments, real estate investment. Did a couple of startup entrepreneurial things along the way. But really, I was looking for that next idea to do something in niche real estate with an operating angle. That's really where I wanted to focus, and I was really excited to get back into it when student housing came along.
Yeah. So student housing, then again, guys, I'm here with Sanjil Shah. Sanjil Shah is the managing partner, effectively the portfolio manager and the founder, the co-founder, if you will, of Alignvest Student Housing. Manages, how big is the fund now?
Yeah. So our assets are valued at $430 million. We have 8 properties, 3,400 beds.
3,400 units?
3,400 beds. In student housing, you measure by the bed because you rent to each student individually.
Right. So, and I remember you telling me about this. Some rooms have 3 beds or whatever, right? 4 beds or whatever.
Yeah, 3, 4, 5. We have a handful of 6-bedroom units as well, but the optimal is around 3, 4, or 5.
Okay. So 3,400 beds that you manage, $440 million portfolio. So let's talk about that transition and how Alignvest started and what you saw in this as an asset class.
Yeah. So again, it's very similar to, what I just said about self-storage. When we started looking at this back in 2017, 2018, we saw what was happening in the United States and in the UK and Belgium. I mentioned there were public companies in each of those markets. In the United States in particular, there are huge players. There's American Campus Communities, which is a large public company. At the time, there was Education Royalty Trust, which was EDR, which subsequently got privatized. And so we started looking at the data, how these companies grown. And what was really compelling to us were a couple of things. One was the ability to invest at cap rates. So cap rates is how you value real estate, right? It's kind of like the expected return on income. And so on your investment, sorry. And so we started looking at in Canada, the cap rates in student housing were trading at substantial premiums to apartment buildings, multifamily residential buildings. And when we looked at the back-tested data in the United States, that phenomenon existed about 10, 12 years ago. But over time, as the asset class has grown and become professionalized and institutional investors have come in, the cap rates in student housing have come down and now trade right on top of where multifamily apartments trade. So, to give you an example, go ahead.
So just a second, I got to back you up and I got to simplify this for our viewers to make sure we're on the same page. So you said a premium to the cap rate, obviously a premium to the cap rate. You're talking about a higher number, which is in fact a cheaper asset class. There's a reverse correlation for our viewers there between cap rate and asset price. The lower the cap rate, the higher the value of your real estate. The higher the cap rate, the cheaper you're getting at. So if you're buying assets, the higher the cap rate, in theory, the riskier the asset or the less valuable the asset is. And you said there was a premium. So in other words, you thought, and I'll let you finish, you thought that the premium would eventually erode, I would imagine.
Yeah, so that's exactly right. I'm glad you clarified that. So, the asset class, because it was misunderstood, people were not willing to pay higher valuations so that, they perceived the risk to be higher. And that was keeping the cap rates in student housing higher relative to apartment buildings. And what we've seen happen in the United States, as the investors got more and more sophisticated and understand how student housing works as an asset class and understand the risk reward ratio and really understand how it provides protection in both economic downturns and an inflationary environment. And we can touch on that in a second if you're interested. The investors got more and more comfortable and started to drive up the valuations, drive down the cap rate. What's happening is in Canada, that institutional capital, the professional investors have not come in yet. So there's still that opportunity to buy at very attractive valuation. So that was kind of our entry point. That was what made it so exciting as an investment opportunity. Then you take it from there to, okay, well, what are we going to do with these properties? These are real operating assets, right? You have students as your tenants. So you have to manage the student dynamics, the student experience. And what became apparent to us is that these properties we're buying, because there was no professional management, they're either passively managed or undermanaged. And so there are all sorts of operational efficiencies we can implement. And we've done this across the board. Every property we go to, we have kind of like a playbook, a day one playbook. What are we going to do? What are we going to turn over? How are we going to drive the operation?
So on that, there's two things happening. One, you talked about, in theory, the reducing cap rate. So think of that as a bond. You've probably thought of the viewer out there. So if you got a 7% bond and interest rates go to 5%, your bond is now worth more, right? So the bond has a reverse correlation. So if you got a 7 cap rate piece of real estate and it goes to a 5 cap rate, the multiples are huge, right? So it's not like you're adding 2% return because one, it's leverage, and two, it's inverse. So if you go from like a 5 to a 4, you're adding, and the math's not exactly that, but you're adding roughly 20 to 25% value on the value of your piece of real estate. So it's a significant bump if you're getting a cap rates appreciation. But two, you just mentioned, operationally, you can increase the NOI because at the end of the day, your multiple of your cap rate is based on your NOI. I guess it's not technically your NOI, but let's call it your operating income, right? So your cash flow that's being generated by your property. So if you have a higher NOI, and I've seen a lot of these real estate projects where management is either in New York or they're in San Francisco or they're in London, and this is 0.1% of a huge pension portfolio. Maybe it's a block in Ottawa or something like that, and nobody's managing it, nobody's looking at it. It's extremely passive. Someone comes in, and that's what I think you're going to talk about. Someone comes in, tweaks things a little bit here and there, increases the rent here because you can get more here, starts charging for this where they weren't charging before. Now your NOI is higher. And if your NOI is higher, you're getting that multiple of the cap rate. So now you're improving things on two levers. Basically, you're pulling two different levers that are adjusting the value of your real estate, right?
You've exactly summarized it. That's perfect, right? So we are buying properties at very good cap rates. We're driving up the return by improving the operations. And then the magic exit formula here is let's wait for the cap rates to come down. Let's wait for the institutional capital to come in. And then we get paid off of that higher NOI, the higher income that we've generated, and the cap rates are lower, so the valuation increases even more. That's kind of the magic formula here, or the opportunity in front of us.
Okay, but it's not all roses and dandelions, right? You go through these periods, and I'll get to COVID in a sec, but first off is, one, you gotta find these. How big is the supply in Canada for these things? I imagine there's not one at every single street corner, right?
No, absolutely not. That is the challenge, right? So, first of all, there are a whole bunch of challenges with Canada, right? We're geographically geographically very spread out, and each individual market is small, which is a challenge, right? So, but we do benefit by having regional clusters. In Canada, our Southwestern Ontario and the Eastern Ontario/Montreal cluster, right? If you think about Southwestern Ontario, 6 fantastic universities, all within an hour's drive time of each other between Brock, Western, Guelph, McMaster, Laurier, and Waterloo. So that's kind of a great epicenter to have an operational center of excellence. If you think about Eastern Ontario/Montreal, you kind of have that same dynamic with Ottawa, Carleton, Queens, McGill, and Concordia. So the reason why that's important is between those two markets, you have almost 40 to 50% of your Canadian university students residing. We don't have to necessarily think about the whole country. Our goal and ambition is to be a national player. So we'd love to be in Winnipeg. We're looking at opportunities at University of Winnipeg, University of Manitoba, but it's a challenge because we have to wait for the developers to build good product. There's some product being built next to University of Manitoba. We've talked to a couple of developers about opportunities next to University of Winnipeg, but it's a waiting game. You have to wait it out and wait for the opportunities to be built. Now, conversely, when you look at Ontario, specifically Southwestern Ontario, it's much more developed, and it's been developed out of necessity because it attracts just such a larger population base of students.
And the wealth, just the sheer craziness and the wealth there. So, okay, so once you find the supply, you hope that it's mismanaged. You hope you can get it at a good multiple. If you do both of those and you kind of just wait, and what happens to the market you think will happen, which is improved NOI, reduced cap rates, cap rate compression, we'll call it, then you get a higher multiple. There's an exit play in your game, right?
Absolutely. Yeah. So we're looking at this as a consolidation strategy, right? We think it takes, we launched in June of 2018. At the time, we thought it would take 5 to 7 years to execute our strategy and look at our exit plan. 2020 admittedly was a bit of a missed year, although we can touch on what we've done in 2020 in a second. So, where we are today, we think it's going to be another 3 to 5 years to finish our consolidation strategy. This is not just buying properties that are priced attractively. We have to buy the properties, and then we have to put in our operational systems, policies, procedures so that we have a ready-made platform. We like to use the word platform because when we think about our exit strategy, there are 2 opportunities in front of us. One is to take our private REIT public on the TSX. Once we cross $1 billion in enterprise value, then we think we're relevant enough to be a publicly listed REIT. And that would provide liquidity to all of our investors and provide investors an option. If you want to stay in and benefit from the ongoing value accretion and yield, great. If you're looking to an exit, you can use the capital markets to exit. The other and perhaps more likely exit scenario is to look at one of these institutional investors and say, look, we did all the heavy lifting. We put together a portfolio that's now north of $1 billion. Why don't you take a look at partnering or acquiring our portfolio? What's really interesting there, Rob, is the largest investors in this space are the sovereign wealth funds out of Asia, Temasek and GIC. But the next tranche of really large global investors are the Canadian pension plans, the likes of CPP, PSP, BCI, AIMCO. They're massive investors around the world. They just don't invest in their own backyard in Canada. So that's our opportunity set. Let's go deliver something to a Canadian pension plan.
Okay, so the exit then is $1 billion and then an IPO in a publicly listed company.
Yeah, so we like, $1 billion is kind of the base case. I would like to say somewhere between $1 billion to $1.5 billion is where we become relevant enough to be a publicly listed company.
Wow. Okay. So what do you say about the fact that I really like your asset for a couple of reasons, but one is I specifically like the fact that you have the reduced volatility and you don't get the euphoria and the manic of the day-to-day, week-to-week fluctuations or volatility in the asset class because it's not publicly traded. What would you say to someone who said, I can get my liquidity just through NAV redemption? If I want to get out, this is clearly a long-term asset. If you're buying student real estate, you're not buying to trade it in a month or in 2 months. You're buying it because you believe in the asset class and you want to hold it. What would you say if I were to say as a portfolio manager, I don't want you to get that liquidity for my clients. I'd rather just be able to redeem at NAV on a monthly or quarterly basis.
So it's a fair question, and we do permit individual investors to redeem. Investments and redemptions are available on a monthly basis, albeit it's very limited, right? We're a real estate fund. Our objective is not to hold cash. We don't have liquid investments. Our investors want us to invest our capital in real estate, in illiquid real estate. So we have a base level of cash that we manage to fund the ongoing redemption requests. Look, life situations happen with investors, right? People pass away, people get divorced, people move countries. So we have to be able to manage that. And because our investments are available for registered accounts, we have to comply with the CRA rules that require us to provide limited redemption ability.
Yeah, but like, have you had a run on capital? Have you had to be concerned about kind of gating the fund or anything like that?
No. So we have been, I'm very clear with everybody. If you're looking at this as a short-term opportunity, this is not really the opportunity or strategy for you. We're upfront. We told everybody when we launched that this is a 5 to 7 year play, and we're upfront with everybody that we look at this as another 3 to 5 years left, and we would encourage investors to come in if they believe in the strategy and the story and the opportunity in front of them.
Yeah, and I would say that for me as a portfolio manager, you and I have had many chats about this, and before I ever put a dollar in this, we were on the same page with respect to that. But for me as a portfolio manager, we get the odd client that is either divorced or passes away or whatever, and we need to move the assets and we need to redeem, and which you guys will accommodate. But for the vast majority of my clients, I actually don't want the volatility. I actually don't want the publicly traded REIT. So I mean, in theory, your play is you get to the IPO, you get a multiple, right? You'd get a multiple on your assets, and then it's like hopefully boot down, right?
That's exactly the opportunity. As a case study, a couple of years ago, there was a private REIT, Continuum REIT. I'm not sure if you followed their story, Rob, but they're the case study of who we want to emulate. They filed to go public, and shortly before they went public, they were taken out by an institutional investor at a very attractive price. And so if we could do something similar, we don't know which way we'll end up, but we have multiple exit opportunities in front of us.
Yeah, I think anyone who's ever managed money for a living will tell you Liquidity adds anywhere from 10 to 40% premium on any investment. So if your fund's worth $1 billion on Liquidity event on an IPO, it's worth anywhere from 1.1 to 1.4, right? Just because you have the liquidity, right?
Absolutely. And for that reason, it doesn't make sense for an investor to trade in and out before that liquidity event.
Yeah, absolutely. If you're buying the story, if you're believing in the story, you're obviously doing it because you want the premiums to compress, you want your management team to improve the NOI, and you believe that that'll happen. And it's happened, and it's modeled, and it has happened in the US, and we think it'll happen here. And when it happens, there's a lot of money to be made because those compressions are going to be multipliers for the end client. So we talked about a potential for a lot of money to be made. Sanjil, I wouldn't be doing my job if I didn't ask you about COVID. Like clearly, they closed universities here. That must have been disastrous for you guys.
Yeah, well, so it could have been disastrous. I'll admit there was a little bit of panic when, last March when right across the country, every university announced that they're moving to online learning and told the kids to go home. We were concerned. This was kind of middle of March, March 13th, Friday, March 13th. I'll never forget that date when everybody started making their announcements. And we didn't know, is this the end of our business? Are kids going to throw back their keys and say, come after me for a rent? There are kind of two measures in real estate that kind of drive your KPIs. One is your occupancy and two is your collections, right? And we're fortunate that on both measures, we've persevered and managed to stay quite strong. So our occupancy has been quite robust, almost 85% across our portfolio, over 90% at our privately managed facilities. 7 properties are privately managed. Our collections are even more surprising. We've collected over 98% of our monthly revenues. And that's worth spending a couple of seconds to talk about. Well, why do the students keep paying their rents? Why didn't they all just walk away? And it's really the structure of our leases that's driving our strong collections. On the one hand, people like to say, well, students are bad credit, aren't they? But the reality is students have no credit, right? They've never worked. They haven't established their credit history. But what we do is we get full parental guarantees on all of our leases. So, the parents of university going kids, I would argue, are of higher credit quality than your average apartment building dweller, right? So we're fortunate that
because if their parents can sell their kids to McGill or Concordia or wherever, the parents are in the top 30% or 40%, they've got fantastic credit probably, right?
Absolutely. So, we started asking the parents, why are you paying the rent? And they said, well, look, for $800 of monthly rent, I'm already paying 10 grand in tuition. I'm not going to default and have a black mark on my credit record. And then something else became apparent that was even caught us by surprise. The other reason parents gave us that they keep paying the rent is these are their kids. They're young adults. They're about to graduate from university and embark on their life. They're going to get their first job, first apartment, first car, maybe buy a house. The last thing parents want to do is set their kids up for life with a black mark on their credit record. So we're very fortunate in our lease structure and our tenant base that it just, compels them to continue paying rent. So, we feel like we've weathered the storm, made it through the worst of COVID. We're now kind of in the beginning of 2021. The universities are coming out day by day, making their announcements in terms of plans for the fall of 2021. So we're quite optimistic. The rollout of the vaccines has been helpful, albeit, the delays have not been helpful. But, we're still quite optimistic that university life will resume with in-person activity. Many universities have now made their announcements that they're going to resume in-person activities for fall 2021. Several universities in Ontario, Dalhousie and Halifax, the universities in Quebec, they've all come out with their announcements. So it's encouraging. And what's happening is every time a university makes that announcement, and we have a property in that market, there's a flurry of activity. To give you an example, Laurier made their announcement about 2 weeks ago in Waterloo. And since then, we've done about 75 to 80 new leases. Just the pent-up demand is coming in, and they're saying, okay, it's time to get my bed. I gotta secure it. There's also a couple of things that are working in our favor here. One is, you think about the university dorms, the kind of the on-campus dorms where traditionally a large portion of students would have stayed. The shared bedrooms, 2, 3, or 4 kids in one bedroom, perhaps in bunk beds or side-by-side beds, and the communal bathrooms at the end of the hallway with 10 to 12 kids. Those don't work in the world of social distancing, right? Where there's a focus now on health, safety, hygiene. So what we're seeing is that traditional students who would have lived in on-campus dorms, they're now coming to us and say, you know what, I'd rather have my own private bedroom and not have to share a bedroom, have my own space and have my own bathroom. So we're really seeing a surge in demand for bedrooms that are private occupancy, and in particular, bedrooms that have an ensuite bathroom. We're very fortunate that over 99% of our portfolio are private bedrooms, and the vast majority of our bedrooms are no more than 1 or 2 kids sharing a bathroom.
That's really interesting. I would not have thought of that. COVID's actually going to give you a bit of a surprise. I'm sharing my screen here. This is a chart about student enrollment growth, basically showing, $110 million increase since 2000. This is the industry as a whole. So we're now in 2020. The industry, the enrollment in millions on the planet has increased. I don't think this surprises anyone if you were to tell them more and more people are going to university, but this is a chart that shows that. And I guess you love this future of this.
Yeah, it's university education is equivalent to what a high school education was, 20, 25 years ago, right? It's just kind of a must-have, a check the box before you can apply for almost any job. So, we don't see any sort of reversal in this trend. And then you look at international students in particular, they are coming to Western countries in huge numbers, and Canada in particular is one of the beneficiaries of that. Our enrollment is growing at a faster rate than both the UK and the US market, driven by both our domestic and our international students.
So this slide here shows the student housing being the 4th best performing asset class over the last 10 years. Now, does this kind of include 2020? Probably not.
No, it does not. It goes until August 2019. We'll update it for 2020. So what's telling here is, if you look at the 10-year span, it was kind of like a boom time, right? The markets were flying. And, this kind of points to, I mentioned earlier on that student housing has proven itself in both inflationary times and in economic downturns. What's positive in inflationary times is because we have natural turnover, our tenant base are students. By definition, every 2 to 3, 4 years at most, you're going to have turnover in your tenant base. So in rent-controlled environments, it's a huge additive where you can reprice your beds and keep your leases at market rate. Versus you look at apartment buildings in an inflationary environment, they're stuck with below market rents because nobody's moving out.
So what do you think if someone were to buy in this asset class, how much do you expect yourself to generate in this fund over the next, till the exit, let's call it?
In terms of a return?
Yeah, in terms of a return.
Yeah, so our target return is to generate a 15% net IRR for our investors. That's going to be a 1.5. Yeah, we think that's a respectable return. That's not, it's not a shoot the lights out strategy. That's a combination of value accretion, NOI growth, which is given to investors in the form of distributions. We pay out distributions on a monthly basis, and our properties are revalued on a quarterly basis by Cushman and Wakefield. So you see both. You see the value accreting of the units, and you see the distributions being paid out.
What is the distribution right now?
It's 5.4%. It's not only it's a 5.4%, something that caught us by surprise. It's very tax efficient. It's a return of capital for tax purposes. So this was something that we didn't set out to intentionally do, but it's been a huge benefit, and it's very attractive to incorporated professionals. Right when we launched. Oh my God,
Sanjil, if you've been watching my show or if you've watched my YouTube channel at all, this is a bit of a passion of mine. I always talk about this. You need to be concerned more than your straight up number. Your after-tax returns are critical. If you have a corporation, and you're in the passive income space, it might be a grind on your small business tax exemption. It's a great way to remove that number from your personal, or if you have a T4 income, you have non-registered assets, and this is therefore increasing your income, you pay tax on that. Those two situations you should absolutely consider, not just you guys, but just any investments that generate return of capital, because by far the most optimal for the high net worth or the corporate investor, man, it's like a 10% GIC, right?
Absolutely. And I say that because I saw it on one of your recent LinkedIn videos, right? So, look, for us, it's a pleasant surprise where the take-up rate by incorporated professionals, the doctors, the dentists, lawyers, accountants, has been fabulous. It was the Trudeau-Morneau announcement was kind of a blessing in disguise for us because they came out with those rules right when we were launching. And, having the return of capital and having the current yield be fully tax deferred and not grind up your small business deduction, it's a win-win situation. We do offer an attractive DRIP program, a reinvestment program, and the take-up rate's been about 50%. It seems like incorporated professionals are more than happy to take the tax-deferred cash distribution, but then investors who are coming in through registered accounts, RSPs, TFSAs, they are opting for the DRIP program.
Yeah. So basically you get $1. If you have $1 of investments, you guys will pay out 5.4 cents per year. Additionally, you hope over time it's going to generate an addition, call it 9 or 10 or 11% of appreciation in the value of the shares. And the neat thing that you're referring to now is none of that gets taxed. The 5.4 is tax-free. It's return of capital. The appreciation of value of the shares, your shares just go from $1 to $1.10 to $1.20 to $1.30. So you don't actually pay tax on that. Eventually on a liquidity event, if you need to sell or pass, or when this liquidity event that you're talking about happens, obviously there will be a day of reckoning for the cap gains, but it's only going to be a capital gain, which will be at half the rate of regular income.
Absolutely. If we can defer taxes for 3 to 5 years and then pay, on half the upside on a capital gains basis, I'll take that trade any day.
Yeah. So just to put the math on this, think of it this way. You make $1. Okay. You have $1 of investments. You make 10% as interest income. Okay. So 10% as interest income, let's say in a bond or a debenture or something. Now you got 50 cents, you got 5 cents left because you paid 5 to the government, right? So now your compounding is only $1.05. So now next year you've still only made 5 cents. Whereby if you're compounding that $1.10, next year, $1.21, next year, $1.32.5. Plus you got that cash. You got the 5.25, 5.5% cash that you could do whatever you want with. You could drip. So if you're dripping it, it's $1.15, $1.32 or whatever, $1.48. So you're compounding on top of your return. So your net returns end up being just dramatically better. And it's not just for you. Like I believe that makes sense as an asset class, but I believe the concept of a properly diversified portfolio that is considering after-tax net return for clients is of utmost importance.
Yeah,
so
I guess just to comment on that, I'd say that in our low interest rate environment, I would challenge you to find a fixed income investment that pays over 10%, and gets taxed at 50%, right? So it's actually, given where interest rates are today and for the foreseeable future, this becomes even more attractive.
Yeah, I mean, you're preaching to the choir. I've been saying this for 10, 12 years or whatever. I've been saying this as interest rates have gone down. It makes absolutely no sense for you to have a 1% GIC or 2% GIC. If it's the volatility that you don't want, there are a ton of alternative asset classes like this one, right? It's not just, multifamily real estate that's the only alternative asset classes. You guys do fantastic work. You can get music royalties, you can get farmland, it's not just stocks, bonds anymore, right? In the investment world. And you guys are proof of that. So what was the return in 2020 for your fund?
So on an annualized basis, we've delivered 11.7% as a net return to our investors. That's annualized since our inception in June of 2018. So 2.5 years, 11.7 annualized, almost 30% on an aggregate basis. But really, if you think about it, it's 5.4% from the distribution and the balance from the accretion in the value. So about half and half.
Yeah. And obviously there wasn't much accretion in the value of the equity last year, just because, Cushman and Wakefield, they're not going to tell you your real estate's worth way more when a pandemic is going on. So obviously I'm guessing you're hoping 2021 and 2022, you start to see some accretion in the value of the shares.
Yeah, absolutely. I think realistically, we'll have to wait until Q4 when the universities are back in action and kids do return to campus. Until then, I think people are being cautiously optimistic. All the signs are in our favor. We're comfortable enough with the situation that we're aggressively pursuing acquisitions again. We paused all of 2020 because there was just too much uncertainty. We did one small acquisition in 2020, but nowhere near the cadence that we had done in 2018 and 19. And now we've got 3 properties under contract, looking to add another 1,300 beds to our portfolio, another $220 million of assets. That's kind of giving you a sense of the optimism we're feeling.
Obviously, you're hoping to buy stuff at a COVID discount, I would imagine.
Well, that you would think so. All of the good news that I have given you about our portfolio, that well-managed, higher quality properties are also experiencing that. So it's not like there's a fire sale out in the market. Conversely, interest rates have come down substantially in the last 12 months, right? So when you think about vendors, they know that we can now finance with first mortgages at almost 1% lower than we could have 12 months ago. So they're not willing to give us all of that benefit. So you would think that, but it's not like, we're not in the hotel industry where there's a lot of distress out there and fire sales. We're looking at a stable asset class that has proven its resiliency and stability through 2020. And vendors are saying, no, why don't I just wait it out? Because I know that kids are going to return in the fall and my income is just going to accrete.
Yeah, I think that's the point that you made and that I was kind of hoping you'd make, is that it's actually a good news. It's good news that we're not buying stuff at COVID discount, right? Because if we were buying stuff at COVID discount, that means our buildings are worth less, right?
Yeah, you should be questioning me then. Am I telling you the truth, right?
What are you worth, right? What are your residences worth? So, hey, on the issue of setting something up like this, you're an entrepreneur, you did this from scratch. What do you have tips out there for anyone who's considering either starting some sort of private equity fund or someone who's just considering getting started on their own business, either stuff that you've seen in your own eyes or kind of the one thing you wish someone would have told you?
Yeah. So for me, I guess, I learned a lot of this because I've done it now twice, in self-storage first and student housing the second time. The approach I've taken is, let's not reinvent the wheel, right? Canada is a small country on a global scale. And typically what comes into Canada has already been tried in other parts of the world. When you look at both self-storage and student housing, I'm just copying something that's been done by other much larger players and done successfully. There's no reason for me to reinvent the wheel. Just take the best of what others have done. In student housing, identified that when we launched, there were 4 public company comps that we could look to outside of Canada. We could see the growth trajectory, and there are huge industry associations in other parts of the world. None of that exists in Canada. So don't be confined to your own backyard. Look at the global stage. Look at what's out there, how other sophisticated investors and entrepreneurs have approached things, and reach out. The one thing that I always find surprising is when somebody's starting a new business, they don't reach out to others in their industry. I call everybody and anybody I can think about. If they're in the student housing industry, I'll call them and say, hey, let me talk. Let's talk. Let's learn from each other. Give me some tips. And you always take away some positives, maybe not immediately, but down the road. So that's something that I've learned as I've gone.
Okay. And what is your all-time favorite book?
So my all-time favorite book is Red Notice. It's a bio written by Bill Browder. Red Notice. It's a bio written by Bill Browder about finance issues in Russia going back about 15 years or so. But it's for anybody who's in business and wants to get inside the politics of the Russian government and how the market opened up and how it was really still controlled and the messaging was very limited. It's a fascinating look. It's a fun read. It's one of those books where you can pick it up and read it in probably 2 days.
Sanjil, what is the documentary that you ended up binge watching during COVID that you think is really good? If not a documentary.
Yeah, so I watch very little TV, to be honest with you. I'm a big sports guy and I watch every and any sport that's on. So, naturally, the only documentary that appealed to me was the Michael Jordan Last Dance documentary. Right, I couldn't wait for that. That was as somebody who grew up in Jordan's era and was first in line to buy tickets when he came to Toronto for the first game against the Raptors. That was something that I enjoyed so much. Speaking
of Jordan and 1987 Fleer rookie card going for several million, I got a project I'm working on right now, Sanjil. You'll love it if you're a sports guy. It's called Unboxing Gretzky. I'm chasing a 1979 Gretzky rookie card and finally got my hands on a sealed box of Topps 1979, 1980 unopened box, unopened packs. And we're going to be opening that live for our clients and our viewers and whoever wants to watch that. So that's coming probably 3-ish months. We're going to be unveiling that. So really, really neat project I'm working on. Alternative asset class, right? Absolutely.
I was a huge sports card fan growing up. I do have one Gretzky rookie card, an OPG rookie. I handed it off to my son a couple of years ago. And
do you know what the grading on it is?
We haven't got it graded. It's not going to be a high grade. It's got its dents and dings in it. So it's more for personal fun as opposed to a value. I'm kind of afraid to get it graded because I don't really want to be disappointed.
Even if it's like a 4 or a 3, they're still worth several $1,000s, right?
Oh, absolutely. I'm sure it is. But, I also don't want to attach a value to it because I have no intention of ever parting ways with it. I've got a massive Gretzky collection of cards. Fortunately, I started collecting in 79, 80. And that was kind of, I was 6 or 7 years old and kind of in the prime of my hockey card collecting days. But a lot of my earlier cards, my Gretzky, my Messier, my Coffey, they've got the corners dinged up pretty nicely from the games that you used to.
Yeah, because that's what we did back in the day. Like I remember I used to get, I used to hate Edmonton because they would always beat the Jets and they would beat Montreal. So whenever I'd get a Gretzky, I'd toss it in the garbage or whatever, right? Because I was like,
that's right.
I don't want that one. I don't want a Gretzky. And boy, if I could go back and grab those from the trash. Yeah, it's just a crazy, crazy time. I started collecting a little bit later, but I mean, I was going over the weekend, just going through some of my cards that I had in my basement. And there's so many cards now that are $50, $100 that I was just like, really? Like a Madonna rookie card is $100? Like I got like 10 of those, right? Like I just blown away. Like anything Gretzky 80s, anything is like at least $100. It's crazy what's happening to that market. And we're going to get into it on this channel. So make sure you subscribe. By the way, if you're watching at home, make sure to subscribe to our YouTube channel. Keep an eye out for the unboxing Gretzky. Take a sec to like and follow us on Facebook. And by all means, if you got questions or comments, send them in. If you'd like to book a no obligation consultation to chat with us about how this might make sense in your portfolio, this particular asset class or any other asset class, do you have a 60-40 portfolio? Do you have 60% stocks, 40% bonds? Is that what you own? Let me tell you, you're underperforming. You're underperforming on a risk-adjusted return, and there's a lot better ways to manage money than what you currently have. I'm telling you, the pension funds, the largest endowment funds on the planet, they don't have 60% stocks, 40% bonds. They got stuff like this in their portfolio. They got stuff like farmland. They got stuff like music royalties. They got private equity. They got multifamily real estate. They got all of that. And that's what we believe in managing money. And that's why, we believe in this asset class as well. And I'm really glad to have Sanjil Shah on today. Anything else you'd like to add for our viewers?
No, just I can't wait to see the unboxing Gretzky show. That's going to be very exciting. Thanks very much, Rob. I really appreciate spending some time with you today.
All right. Thanks so much, guys. I'll see you in the next video. Have a great day.